was talking to a first-time home buyer the other day who said that they decided against purchasing because it was unlikely that they were going to pay off their mortgage in their lifetime, and they didn't want to leave their children with the burden of a mortgage payment when they were to pass away. Now, naturally, there are some very important details that are overlooked in this thought process, like the fact that most people would probably be grateful for being given any asset, especially an asset that consistently increases in value like real estate, and that in the event of their passing, they could leave that home to their loved ones who could reside in that home and avoid paying rent, or they could keep it, collect rent as residual income, or sell the property and the equity could be dispersed accordingly. This made me realize a bigger issue of importance. That was that I had not recently gone over renting versus owning and 5-year projections and comparisons. Let me start by saying that although this example is based on actual statistics and current mortgage pricing scenarios, your pricing and qualifications will vary. With that being said, let's get into the math of it. The average rent for a 4-bedroom home in the Houston area is $2,567. The median home price for a home in the Houston area is about $368,000. Over the course of 5 years, if you're renting, you will have spent about $154,000 in rent. Buying a home in today's market at a price point of $368K, putting 3.5% down, you should be able to secure a payment with taxes and insurance for about $3,014 per month, give or take. Paying that mortgage over 5 years has you investing approximately $180,840. Here's where it gets really interesting. With renting, it's pretty simple. What you've spent is spent. You lived in and rented that space for 5 years, and it cost you $154,000. That money is gone. You got nothing else to show for it. Let's have a look at the buying comparison side of things. 5 years or 60 mortgage payments towards this home that you should have bought at $368,000 5 years previously has reduced your mortgage balance to $334,092. You purchased the home 5 years ago for $368,000. Now you owe $334,092. You have about $34,000 in equity, right? Wrong. Remember, equity is the difference between the value of the home and what you owe. Now, according to Redfin.com, the average single-family home price in Houston grew by approximately 16.83% over the past 5 years. To be fair, we did experience quite a surge through COVID. We're gonna use less than half that amount. We're gonna say that home values will increase by 8.42% over 5 years. 8.42% of $368,000 is an increase in value of $30,986. The home that you should have purchased 5 years ago for $368,000 is now worth $398,986. You owe $334,092 after 5 years of paying your mortgage. Projecting just half of the 5-year value increase, you'll be sitting at approximately $64,894 in equity. Now, some of you might be thinking that you invested $26,840 more in mortgage payments over 5 years than you would have paid in rent. I would point out that rent would more than likely rise every year. More importantly, even if we subtract that $26,840 from the roughly $65,000 you have in equity, you're still left with over $38,000 and an asset that's going to continue to appreciate over time, because unlike most assets, real estate satisfies a universal need for providing shelter. We all need a roof over our head and have to pay for that roof one way or another. How much wealth is accumulated from your renting?